If you're a seasoned dividend investor, you're probably well familiar with what REITs are. Real estate investment trusts are a great investment for people seeking income from real estate properties. Because REITs are required to pay out 90% of their earnings back to shareholders in the form of dividends, they're very lucrative for people looking to live off passive income. And according to what I could find, the average dividend yield for a publicly traded REIT is about 4.3% as of the making of this video. Probably most of us are familiar with such REITs as Realty Income, Federal Realty Trust, and WP Carey, which are all publicly traded on stock exchanges. Much like your typical stock, REITs can trade in the stock market, which makes them super convenient. In fact, there's probably no easier way to invest in real estate than with a publicly traded REIT. Not to mention, there's a lot of really good websites out there like Yahoo Finance and Seeking Alpha that provide a lot of good information on them that you can use to analyze each REIT. While this is the most common way to invest in REITs, something that fewer people might be aware of is that there's actually different types of REITs. First, you've got public REITs, which are what Realty Income and WP Carey are. They're traded on major stock exchanges or in over-the-counter markets. But then you've also got private as well as non-listed REITs, which aren't traded on stock exchanges. Some of these alternative REITs have their own investing platforms that allow you to directly invest through their website or smartphone app. Fundrise, Realty Mogul, and DiversiFund would be some examples of non-listed REITs you can invest in using Robinhood or whatever brokerage platform you use. Then there's also REITs where you can only invest in them by contacting certain financial advisors. Some of these REITs would include Royal Oak Realty Trust and Starwood Real Estate Income Trust. While there are much fewer of these non-listed and private REITs in existence, I think that with so many options out there besides publicly traded REITs that we're used to, it's definitely worth analyzing these different options for investing in REITs to see where our money would be best spent in order to maximize our returns and provide us with the most passive income. For full disclosure, I'm not sponsored by any of these companies or investing platforms that I'm going to discuss in this video. I don't have a referral link to Fundrise that'll give me a bonus if one of my viewers signs up or anything like that. And also feel free to click the like button below if this video provides you with any sort of benefit, and subscribe if you want to see any more dividend investing strategy videos, which is what my channel revolves around. So with that being said, let's go ahead and get started. I'm going to be comparing these private and non-listed REITs with what's probably the most popular publicly traded REIT out there, and just so happens to be my favorite REIT, which is Realty Income. It trades under the ticker symbol O, and as you all are aware, shares can easily be bought through a brokerage account. If you go to any financial website like Yahoo Finance or Seeking Alpha, you can see a lot of good information about Realty Income right up front. They pay a monthly dividend at a rate of about 23 cents per share per month, which gives it a dividend yield of about 4% as of the making of this video. The best thing about publicly traded REITs is that there's no lack of transparency. Because they're registered with the SEC, they're required to publicly release their financial statements, which have a lot of information on their earnings and revenue. We also know exactly how much investors were paid in dividends, as well as how the share price has changed over any certain period of time. This information obviously helps us in trying to project how much we can expect to earn in passive income from these investments. With platforms like Fundrise and Realty Mogul, it requires a little more digging to figure out how much you can expect to receive in dividends, and even what they do usually provide are estimates. And for some REITs like Nico, I wasn't able to find any information on dividend distributions or past returns on their portfolio. I think it's pretty annoying that some of these websites make you sign up for an account just to provide you with some of their fund's information. If they're registered with the SEC, you can look up more detailed information like their past performance on Edgar, but still this information should be readily available if you ask me. And I get that Realty Income never produces estimates as far as what we can expect to earn in dividends, but given the company has either maintained or increased their dividend every month for decades, we can estimate that it'll be likely that the dividend next month will either be the same or they'll increase it. Realty Mogul was one platform that was a little more upfront, claiming that they offer distributions of roughly 6% of their portfolio's NAV or net asset value. With a lot of other non-listed and private REITs where you need to talk to a financial advisor in order to invest in them, such as Royal Oak Realty Trust, I did notice that they do tout some impressive numbers. They aim for a dividend distribution rate of 6.55% and have a compound annual growth rate of roughly 10%. Starwood has an annual distribution rate of roughly 5.68%. Heinz Global Income Trust has a dividend rate of about 6.1% as well. All of these non-listed and private REITs that I could find did have dividend yields greater than the average of 4.3% for public REITs. But all of these alternatives to publicly traded REITs do have their fair share of headaches when it comes to investing in them. For example, with most private REITs like Four Springs Capital Trust or with the real estate platform CrowdStreet, you need to be what's known as an accredited investor in order to be able to invest in them. This is a rule that applies to any time you want to invest in securities that aren't registered with the SEC as a way to protect less sophisticated investors, as they would describe it. In order to qualify as an accredited investor, you need to prove to the SEC that you made over $200,000 every year for the last 2 years or $300,000 if you're married. Alternatively, you could also become an accredited investor if you have a net worth exceeding $1 million. Needless to say, it's a sizable hurdle that most people aren't able to meet, and it makes investments in CrowdStreet or Four Springs Capital not available to most people. But for public non-listed REITs such as Fundrise, Realty Mogul, and Starwood Real Estate Income Trust, these are registered with the SEC, and so you don't need to be an accredited investor. But even though these REITs are easier to invest in, there's still drawbacks to investing in these kinds of REITs. The first being their investment minimums. These REITs can have investment minimums ranging anywhere from a few hundred to a few $1,000s, whereas with publicly traded REITs, you only need to buy one share of the cheapest REIT in order to be considered a real estate investor. There is one major benefit that some of these real estate investing platforms have over publicly traded REITs, and that is with some of these platforms like Fundrise and ARC7, they give you the freedom to pick specific geographical areas or even specific buildings that you want to invest in. If you buy one share of Realty Income, you're actually buying a tiny fraction of every single property in their real estate portfolio. So that might include businesses and properties that you might not want to own if you did in fact own every single individual building. But with some of the websites I just mentioned, you can invest in specific states, cities, or just in individual properties. Maybe you want to invest in just 1 or 2 apartment buildings specifically. Buying a publicly traded REIT won't give you that option, but platforms like ARC7 do give you some of that freedom. I also really like the platforms of some of these services, which actually break down where every single dollar you invest is going, which is pretty neat if you ask me. Another newer real estate investing platform that I think is pretty unique is called Nico, which is advertised as being the first neighborhood REIT. Nico owns real estate only in the Echo Park neighborhood of Los Angeles, and they claim that because they're structured as a public benefit corporation, their main goal is pursuing positive social and environmental outcomes as opposed to only maximizing shareholder wealth. If that sounds interesting to you, you can check out mynico.com, and as I mentioned earlier, I'm not sponsored by them or any of these companies, I just think it's a pretty interesting and unique concept. The second biggest issue with REITs that aren't publicly traded is that they're illiquid, meaning that once you've invested your money in them, it can actually take a long time to sell your holdings. If you buy shares of Realty Income, you can sell your shares whenever you want as long as the stock market is open. But with Fundrise and other similar platforms, you're required to keep your money invested with them for a minimum of at least 5 years before you withdraw. They do claim you can request to cash out early, but it's entirely up to them if they want to honor it or not. I've never been a fan of having my money tied up for years in something, and I'm assuming that most people who prefer to invest in REITs over actual real estate have the exact same feeling. It's definitely reassuring to know that I'm not tied up in something that I can't back out of. If I ever suffered a serious medical injury and needed emergency funds to cover expenses, these private and non-listed REITs will either deny your request, or you could end up having to wait months for another buyer to come along and buy your existing shares. So in answering the original question in the video title, do private and non-listed REITs pay higher dividends than publicly traded REITs? On average, from my research, private and non-listed REITs do seem to pay a little higher dividends on average. However, given the cons in investing in these alternative REITs, such as higher minimum investments, illiquidity, and needing to be an accredited investor in certain instances, investing in these alternative REITs probably doesn't make a lot of sense for some people. As is the case every time you invest in something, make sure to perform your own due diligence to determine if the investment is right for you. If you want to handpick specific regions or buildings to invest in my opinion, I think that makes the most sense to use some of these platforms. Another consideration is that especially with these newer platforms like Fundrise, which was founded in 2012, they've never been through a rough real estate market, so we don't exactly know how they'll react in a bad economic downturn. Not to mention, most of these private and non-listed REITs only pay quarterly dividends, whereas there's numerous publicly traded REITs that pay dividends every month. Realty Income, Stag Industrial, and Agree Realty are 3 great examples of monthly dividend REITs with some good growth behind them. You've also got AG&C if you're more focused on income over growth. If you want to find a list of private and non-listed REITs, NA REIT's website has a database of these alternative REITs that you can search for. It's just a great resource for learning all things about REITs as well. I'll also keep my eyes out for new real estate investing platforms out there and check out any new ones that I think might be worth looking into. Alright, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the thumbs up button below, and also subscribe if you're interested in more aggressive dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content. Okay, thanks again guys, and I'll see you next time. Take care.